In this lesson, I'm going to talk about using supply-demand as a trend indicator. You see, supply and demand technically works in both directions, but I see a number of traders who tend to place limit orders that are located in the middle of nowhere in both directions as the strong zones are coming up, right? So they don't take the location of the zone into consideration. And then they find out that the majority of these kind of zones do not work out. But whichever direction that you plan to take, ultimately you must still ensure that the zone is at a swing extreme. If it's not at a swing extreme, it doesn't matter how strong the zone ends up scoring. The zone will ultimately be weakened by its position in relation to the swing extremes. Some traders will also claim that supply and demand trading is just a counter-trend trading method, but this is not strictly true. In fact, 70% of the time you will be trading with the trend from a much larger time frame if you're doing it properly. And these kind of trends will be taken from at least a couple of larger time frames, and that's the safest way to do it. It's not the only way to do it, but definitely the safest way, especially when you're first starting out with supply and demand trading. But it is true that at the time of your trade execution, the price will indeed be moving in the opposite direction up until that point. However, trading with the trend does have its final destination. There comes a point when the price reaches its intended destination in the form of my Q points concept, and these are mostly taken from the daily chart. What you want to do is to stop trading with the trend when the price reaches a daily Q point. In order to get this information, exactly which trend you need to follow, when it comes to supply and demand, there are a specific set of rules. However, it doesn't involve the standard higher highs and lower lows method. In fact, looking at higher highs and lower lows is quite possibly the least accurate way of looking at a trend. Now, I will be honest, my method, our method, the market stalkers method, actually uses my own Q points for direction, which is another option, and it's a technique that will be described in one of the following lessons. But today I'm going to take you through these rules on how to use supply and demand as a trend indicator. Now, there's something that's largely missed by people who have kind of gathered free information on the internet about the supply and demand, and then mixed it up with some other subpar methods of trend reading, and in some cases even mixing up support resistance with supply demand. And the thing that is missed is the fact that there are really two ways of using supply and demand zones. The first one, of course, is to find these accurate entries located at swing extremes. But the second use of supply and demand is to determine the prevailing trend. When you're using supply and demand as a pure trend indicator, it's actually much simpler than having to score the zones, looking for specific price action at the time of zone creation, and all of that good stuff. And if you've seen the previous lessons on supply and demand, you may remember the scoring table. You needed 6 different conditions before you even deemed the zone acceptable for a limit order, okay? Well, for trend reading purposes, you really only need one condition. Reading trend for most people is a very kind of flimsy, weak skill, but at the same time, not all higher highs and lower lows will be equally important. So when it comes down to determining whether a trend has actually changed or not, higher highs and lower lows are generally a very poor indicator. And to show you what I mean, here's a USD CAD daily chart from a while back. So at the time when I took the snapshot of this chart, USD CAD has been in a very long-term uptrend. And you can see that now the prices are falling. But which lower low will actually signal a change of trend? Was it a break of this one? Is it a break of this one? Is it a break of one of these when they come up? You know, how would you determine which lower low is more important than the other one? It's very difficult, right? Especially when strong trends are in force. And I can see some of you saying, well, a change of trend will happen when the support gets broken. So let me remind you what a definition of traditional support states. Definition of support. It's a price level which historically a stock has had difficulty falling below. It is thought of as the level at which a lot of buyers tend to enter the market. And where is that level on this chart? Can you see it? Because I don't see it. I see a gradual trend just kind of meandering upwards and upwards and upwards. The support where the buyers visibly entered the market was back in 2013. So what does that say? That until that support from several years ago gets broken, the trend is still up? It's not really a usable way to look at a trend change, especially if you're trading stocks, where uptrends can be relentless because it's the nature of stocks. They will always have some sort of an upward bias, especially when you're looking at the largest companies in the world. So the problem that needs to be solved really is this. When is a move merely a pullback? And when does a pullback turn into a change of trend? So until you have a hard and set rule on this, you won't really be able to determine the pullback versus trend change, systematically speaking. And over the years, we've had some traders who came through Blatek who have ferociously argued with me on this. And I'm not claiming that this is like the absolute best way to look at the trend, but it's certainly much better than simply saying, oh, the price is making higher highs or lower lows. So let's go back to that USD CAD chart again, but this time I'm going to mark the first obvious demand regardless of whether it's strong or weak. So here it is, very obvious demand. Now, would you say that until the price breaks through that area, the trend is still up? It's simply a pullback. Would you also say that once this has been broken, it will clearly signal that the trend has changed? Because I would. I can already see that on some lower time frames, the trend has changed to down. But as far as the daily chart is concerned, which should be your reference time frame for any swing trades, this demand will be the first line of support that will show you if the price has truly changed trend or not. And I mean, look, it's entirely possible to see a very early trend change through candlestick patterns plus market profile analysis. But if you're only looking at supply and demand, then for your trend change, the best way to look at it is this. While the significant demands are holding and they're reactive, the price is in an uptrend. When the significant supplies are reactive, the price is in a downtrend. So back to the USD CAD chart. As long as this demand provides a bounce point for the price, it is still an uptrend from that higher time frame view. Once this area breaks, it implies that a significant demand has been taken out and the price is now officially in a downtrend. And I'll get to the point of what makes an area of supply and demand significant for the purposes of trend change. But for now, here's a rule to watch out for when you're coming up against opposing zones. In uptrends, all supplies will eventually be broken. In downtrends, all demands will eventually be broken. So not only the significant ones, but all opposing zones will be taken out eventually. In my weekly YouTube videos, you may hear me say things like, oh, this zone is a bit too high up in the distribution curve, so if the price turns, it's unlikely that it will hold. And this is because I'm expecting a trend change based on my Q point rejection as well, okay? So therefore, if the price indeed does turn, I expect those opposing zones to start getting taken out. So let's think about this in a practical trading way. What this really says is that if something is going up and has previously taken out a significant supply, it really doesn't matter if you have a very strong supply coming up or not, because if you know that something is in an uptrend, you also know that eventually that supply will not survive. So I'm not saying that the opposing zone may not be reactive, because it might be for a time as the price runs into it. So what's likely to happen is that you will have an initial reaction, which sometimes not knowing what your trend is and running into an opposing zone can make it seem as if you're correct on your trading direction. But eventually, what happens is that if you are trading against the prevailing trend, the price will keep coming back to the zone, going deeper and deeper into it, and then eventually the zone will be broken. Due to this initial reaction, it is entirely possible to find these intraday opportunistic trades. Point being is that if you do have an opportunistic intraday trade, these zones will not be suitable for swing trading because they will not survive for long enough. Just like on that USD CAD chart, if the pullback indeed represents a change of trend to the downside, then the demand should be minimally reactive before the price takes it out, meaning that a lower low that comes after that really does matter at this point, but not out of context. So if you've done your supply and demand analysis and you've noticed a significant opposing zone was taken out, either the 4-hour chart or even the daily chart, then any kind of counter trend trades from strong opposing zones should be avoided. It doesn't matter that the zone is strong, okay? Supply and demand is not a counter trend system. When you take your trend reading from at least two larger adjacent time frames. So what makes a zone significant? I said before that it only needs to satisfy one condition, not 6 like we need for entries, because this is purely just for trend purposes. The one condition that the zone needs to have in order to be deemed significant is to have a minimum of 3-to-1 profit margin. If a zone doesn't have 3-to-1 profit margin, it's too small a move to bring a trend change. This has nothing to do with your own risk reward on the trade. Where you decide to book your trade is a different matter completely. Because let's say that demand on USD CAD that we were looking at, let's just zoom into that. It has about, 12 times profit margin? I mean, is it wise to hold a trade for that long? Because you don't know whether this is going to go up or not. On top of that, if the market starts moving upwards, you have 2 supplies to break through. Here is one, okay? And here's another one. So really, this particular profit margin, although it came from all the way up here, realistically, you can only guarantee that this move may come up to this first supply. At that point, you don't know what's going to happen. So the first question is, what if this pullback is a trend change? What do I expect to happen? What could happen? So scenario 1, if this whole pullback that we're seeing represents a future trend change, and it is a trend change, then this demand will either be broken or be minimally reactive before it gets taken out. So what do I know from this? I definitely don't want to sell into it. Okay, we know that much. In fact, if I want to sell off the back of a possible downtrend that this move may represent, you're going to want to find a higher supply somewhere. You don't want to be selling into a demand. That's a terrible idea. Scenario 2. What if we are still in an uptrend and this demand ends up being reactive and having a decent bounce? then you would expect to see a rejection candlestick pattern already on lower time frames, starting with a 30-minute chart, then a 1-hour chart, eventually 4-hour chart, and then eventually a daily chart as well. Markets have a fractal nature. As long as you've identified an area that will cause a directional change, it really doesn't matter which time frame you will end up using to position yourself. Now, if this demand ends up reactive and it does move up, it's likely that the price will at the very least end up at the first available supply. So this means it's still an uptrend, okay? You got your bounce. And then it is safe to aim for your profit at the next available supply. And scenario 3, what if the trend does change and yet you've entered a trade based on an assumption that it's still an uptrend and that trade loses? It's fine. It's fine because you've just paid a little bit of money for some extra information. Now you know that it's a confirmed downtrend. You can look for a creation of a new 4-hour Q point, a Q high in this case, if you want to sell into it, and you want to sell the rallies. So any upward move now will become your opportunity to sell the rally. Once you start doing systematic trading, the aim is to stop looking at your losing trades as something negative, but instead to see them as a way to get some extra information out of the market. Moving on to the last part, I'm going to give you another rule here. So the rule on trend is that the 2 out of 3 adjacent time frames need to align for a trend confirmation. And bear in mind that if you're looking at a 30-minute chart and a 1-hour chart and then try to trade from that kind of a trend, really 30 minutes and 1 hour, they give you the same type of information. Which is not really the case with a 4-hour chart and a daily chart, because daily chart is actually 6 times larger than the 4-hour chart. So it obviously gives you a different view. 4-hour chart is the smallest medium time frame that you can use both for intradays and for your swing entries. Another point to make is that if you are looking to trade supply-demand areas from a low time frame like a 30-minute or a 1-hour chart, these are usually only relevant for about 12 hours. Anything over, really anything over a session, maybe a couple of sessions for certain products, and the probability of those lower time frames goes right down, like right out the window. For the 4-hour chart, that time frame is about 24 hours. So again, if you're looking at a 4-hour chart that has some zones from like a few days ago, it's going to be a little bit tricky, which is why I advise you to use the confirmation through developing price action on a lower time frame at your 4-hour zone to make sure that there is a rejection. It's very difficult to guess which 4-hour zone will be reactive if it's older than the 24-hour period. Here are some things to remember. 4-hour time frame is the go-to time frame of many successful traders. If you're ultimately aiming to be an intraday trader, which is the toughest form of trading, I start to teach you how to trade from a 30-minute chart around about the same time that I start teaching you market profile. And I really wouldn't recommend that you start using a 30-minute chart before you learn about market profile. I do have a shorter Udemy course that only focuses on market profile if you want to get started on reading day-to-day sentiment. Now for the most important part of this lesson, once the price has arrived at an opposing Q point, the trend that was in force up until that point is completely irrelevant. Why? Because you've reached the destination of the intended move. Think back to Q points from my other lessons. Q points represent the systematic, established, confirmed swing extremes. If you imagine that the moves from one Q point to the other Q point are kind of like train stations, so you have a train going from A to B, namely Q low and a Q high. When you reach an intended Q point, i.e. the destination, would you still try to board the train at B to go to B and reach the final stop, B? Hopefully not. You're going to look like a right nutter. So at B, the opposing Q point of a swing extreme, the train is actually expected to turn around and go back where it came from, right? Therefore, you can go with the trend until such time that you reach the opposing Q point, and then you need to start watching the developing price action to see whether it will signal a reversal. And this has nothing to do with the trend at this point, okay? It's the end of the move. So you need to combine Q points and or supply demand areas with the developing price action at a Q point. So once the price has arrived there, you need to start watching the developing price action. I have an entire lesson on this coming up because my market stalkers over the years, we've moved away from looking at a trend through only supply and demand, and instead we actually use Q points as a directional indicator, and it works really well. And it's an even more efficient way, instead of looking at supply demand zones as a trend. But I do have these conditions that say stuff like Q point low recently rejected or Q point high recently rejected, and this would give you the direction for either swing or for intraday trading. And I see these rejections from Q points happen over and over and over. And that's why I can pretty much guarantee that the price will reach an opposing Q point. What I cannot guarantee is that it's going to reach the supply and demand zone as well, especially if you're only staring at one time frame and only using one time frame for all of your trading decisions. Because how do you know there isn't another larger time frame opposing area coming up ahead of the one that you're currently looking at? So it puts you at a disadvantage just staring at one time frame. Whenever you are in a trade, I would highly advise you to switch back to higher time frames for your profit targets. Instead of looking at the same time frame and then kind of hoping that the price may go all the way into the 30-minute demand where you want to take off your short trade, maybe have a look at the daily chart or even a weekly chart to see whether there's something coming up ahead of that. So here is a flow diagram that summarizes exactly what kind of setups you should be looking for. And clearly this is a vast simplification of the setup, but nonetheless it's a good starting point for future systematic trading decisions. So for longs, so if your trend is up, you are looking for the price to fall into a daily or a 4-hour Q point at the very least. And then you also want the demand zone, if there is one, to have a profit margin of 5 times. And that would be a condition for a long swing trade. Obviously, if you have a Q point high, then you shouldn't really trade. There is an expansion on this coming up. But, like I said, vast simplification of the setup. So ideally, H4Q high, no trade, right? For the short trades, the opposite would be true. So if you have a trend down, you're looking for a D1 or a 4-hour Q point, Q high, with the area to have a profit margin of about 5 times, and that would be your setup for a short swing trade. From these two decision-making flow diagrams, you can then also begin to extrapolate the following diagram that pertains to the developing price action around the opposing Q point. So this is the little expansion on the setup, which means that if you're in a trend up, you get a test of a daily or 4-hour Q low. If the area has a profit margin over 5 times risk reward, it's pretty much a no-brainer. You can look for your long swing trade setups. But let's say you are in a trend up, however the price comes up to the daily or 4-hour Q high, if you have a 4-hour or a daily bearish engulfing or consolidation, you could possibly have an opportunity for a short swing trade. This would mean using the opposing Q points for an early trend change. I will elaborate more on this in the coming lessons. So if you have a trend down, obviously same thing. If you get a Q high visit, you look to see whether the area has a 5 times profit margin, and you can then immediately go for the short swing. If, however, you are in a trend down and the price arrives at a daily Q point, if you end up seeing a 4-hour or a daily bullish engulf or a consolidation, you can then start to plan out your long swing trades. Okay, so it's not that complicated. You know, it looks super complicated, but it isn't. It's all very, very logical. So it's all just conditions that must be there, and then a small binary decision that takes you to a yes trade or a no trade. If you are already using our Blotic supply demand indicator, all of this is already hard coded. So at a click of a button, you can see whether the trend is up or the trend is down. You can see where the Q points are. You don't have to do anything manually. And I've included a link to the indicator. That depends on where you're watching this. It's either going to be in the first lesson or in some kind of a resources section somewhere. But with any indicator that you're using, like I said before, you really need to learn the methodology behind it rather than just blindly following it and not knowing why the indicator is showing you what it's showing you. The whole point of this flow diagram is to give you a little inkling that yes, there is a possibility of doing effectively a counter trend trade from the opposing Q point, but not if you don't have the developing price action that is showing you a rejection. Okay, time for the summary. So today we've looked at 2 ways of using supply and demand: pullback or a trend change. So playing out the scenarios in your head of what could happen, something you need to start doing. Then I talked about what makes a significant supply and demand zone. It's the ones with a 3-to-1 profit margin. We've also looked at trend confirmations on multiple time frames, that you can look at 3 time frames, 4-hour daily and weekly chart, and then to have at least 2 of the 3 adjacent time frames telling you the same thing, and that comprises your prevailing trend. And then I showed you a couple of flow diagrams to help with some of these swing setups visually, as well as possible opportunities that we'll speak of more in the coming lessons for counter trend trades once the price arrives at those opposing Q points. And that is it for this section.